Assalamu alaikum. In this video, I will try to explain some basic concepts related to capital budgeting techniques. The most common used techniques are net present value, internal rate of return, payback period, discounted payback period, accounting rate of return, and profitability index. I will try to explain some basic criteria and advantages as well as limitations of these techniques. Most economic activities could be conducted through open market purchase of material, capital, and labor inputs and subsequent open market sales of product and services. But such commodity market productions would be highly competitive and only marginally profitable. The driving force of all modern economies is the exploitation of new technologies and the transfer of production to ever more capital intensive process, and these objectives can only be accomplished by companies with vast pool of financial, technical and human resources. The most successful companies are those companies which have developed effective programs both for generating investment opportunities and for selecting the most promising projects from the set of opportunities available. That's why the capital budgeting technique is the most important concept that is widely used by the corporate financial managers as well as in other finance areas. Capital budgeting is the process of evaluating and selecting long-term investments that are consistent with the firm's goal of owner's wealth maximization. Capital budgeting and financing decisions are treated separately. In capital budgeting, the main focus is on determining acceptable projects, while in financing decisions, the main focus is on arranging funds for the projects at minimum cost. In capital budgeting, we only work on capital expenditures. The capital expenditures are compared with current expenditures. The capital expenditures are an outlay of funds that is expected to produce benefits over a period of time greater than 1 year, whereas the current expenditures are an outlay of funds resulting in benefits received within 1 year. So in capital budgeting, the main focus is on capital expenditures. Fixed assets outlays are capital expenditures. Not all capital expenditures are classified as fixed assets. For example, advertising required a huge expenditures, but the advertising expenses are not considered as fixed assets. The capital expenditures are made for many reasons, but the evaluation techniques are almost same. The basic motivation for capital expenditure are to expand, replace or renew fixed assets or to obtain some other less tangible benefits over a long time period. While working on capital budgeting, there are some basic principles that are followed. These includes decisions are based on cash flows. In accounting, we have different financial statements like income statement, balance sheet, cash flow statements and other statements, and these statements report accounting figures. But in capital budgeting, we base our decisions based on cash flows. The timing of the cash flow is crucial. A cash flow received at the start of the year or at the end of year have different values, and these values are considered while working on capital budgeting. Cash flows are incremental. While working on capital budgeting techniques, we consider cash flows that are incremental. That is, such cash flows are based on opportunity cost. Cash flows are on an after-tax basis because cash flows related to taxes are part of the cash flow that must be analyzed. Financing costs are ignored. We have already discussed that in finance there are two basic decisions, financing decisions and investment decisions. In capital budgeting techniques, we only focus on investment decisions where financing cost, financing decisions are ignored. Normally, firms apply a capital budgeting process to evaluate different investment options. The first step is generating ideas. Generate ideas from inside or outside of the companies. The second step is analyze individual proposals, collect information and analyze the profitability of alternative projects. In second step, we normally calculate cash flows related to these different proposals and the profits or costs associated with these proposals, evaluate alternative projects. Planning the capital budgeting is the third process. Analyze the fit of the proposed projects with the company's strategy. We already know that the basic purpose of finance is to maximize the wealth of shareholders, and while evaluating each proposals, we have to see that which proposal or which project will increase the value of the firm or increase the value of shareholders. The fourth step is monitoring and post-auditing. Compare expected and realized results and explain any deviations. Sometimes when we implement some projects, there might be some minor changes or revisions that are required. But this process should be implemented carefully, as many firms have no opportunities to revise this project and they cannot afford to fail of any projects. That's why the firms work out on projects and only select projects if they add values to the firms. That's why the financial managers work on evaluating these projects and decide the best projects that can increase the value of the firms. There are some basic terminologies that should be clear before understanding the capital budgeting techniques. Some projects might be independent projects and there might be some mutually exclusive projects. The independent projects are those projects whose cash flows are unrelated or independent of one another. The acceptance of one does not eliminate the others from further consideration. For example, the owners might be interested to improve the technology. They might be interested on building of the new plant. They might be interested on human resource development or other projects. Mutually exclusive projects are projects that have the same function and therefore compete with one another. The acceptance of one of a group of mutually exclusive projects eliminate these all other projects from further consideration. For example, if you want to buy a car, you might consider that you will buy a car of Honda company, of Suzuki company or any other company. If you buy any car, then you will exclude the other options. Sometimes in capital budgeting we have unlimited funds, while sometimes we have to work with the capital rationing. If a firm has unlimited funds for investment and all independent projects that will provide the returns greater than some predetermined levels can be accepted. While in capital rationing, the capital rationing means that firms have only a fixed number of available funds for the capital expenditure and that numerous projects will compete for these limited funds. The firm will only select the best one among many projects. The firms might have two different techniques to select the projects: accept or reject approach, the ranking approach. The accept reject approach involves evaluating capital expenditure proposals to determine whether they meet the firm's minimum acceptance criteria. The accept reject approach can be used when the firm has unlimited funds as a preliminary step in evaluating mutually exclusive projects or in a situation in which capital must be rationed. In these cases, only acceptable projects should be considered. The ranking approach involves ranking projects on the basis of some predetermined measures such as net present value or internal rate of returns. The projects with highest return is ranked first and the projects with the low return is ranked lowest. Only acceptable projects should be ranked. The ranking is useful in selecting the best group of mutually exclusive projects and in evaluating projects with a view of capital rationing. In capital budgeting, some projects have conventional cash flows and some have some non-conventional cash flows. A conventional cash flow pattern consists of an initial outlay followed by a series of inflows, whereas non-conventional cash flows pattern in which an initial outflow is not followed by an uninterrupted series of inflows. Here is an example of conventional cash flows. In project 1, we have initially cash outflow, then we have cash inflow in later 5 years. In second project, we have cash outflow in first year and second year, and then we have positive cash flows for the rest of the life. In third project, we have initially cash outflow and then there is no cash flow, and after that we have positive cash flows. There is only one sign change during the life of the projects. These are examples of non-conventional cash flows. Here we have cash outflow in the first year and then we have cash inflows for the next 4 years, and in last year we have again cash outflow. In second example, we have again first year cash outflow. In second project, we have again cash outflow in the first year, then cash inflow, then cash outflow, and again cash inflow for the next 3 years. In project 3, we have cash outflow in the first year. In the second year, same, we have cash outflow, then cash inflow for the 3 years, and in last year we have again cash outflow. Normally the cash outflows arise due to investments, shutdown cost, or environment mitigations. In capital budgeting techniques, some projects have annuity cash flows whereas some has mixed cash flows. An annuity is a stream of equal cash flows at a regular time interval and for the specific time periods, whereas any pattern of cash flows other than annuity are mixed cash flows. Identifying the relevant cash flows. The incremental cash flows represent the additional cash flows that is expected to result from a proposed capital expenditures. Cash flows rather than accounting figures are used because these cash flows directly affect the firm's ability to pay the bills and purchase assets. Furthermore, accounting figures and cash flows are not necessarily same due to the presence of certain non-cash expenditures on the firm's income statement, like depreciation is a non-cash expenses that is included in the income statement, where in capital budgeting techniques these are not considered. The cash flow of any project have conventional pattern and can include these basic components: an initial investment, operating cash flows, and terminal cash flows. For example, we have a project where we have initially 1 lakh cash outflow, then 30,000 cash inflow for the each year, and 20,000 is received as a residual value when the project's completed its life. The 1 lakh that is invested in day 0 will be considered as initial investment. The cash flows that are received 30,000 in each year for the 5 years are known as operating cash flows, whereas 20,000 received at the end of the project is known as terminal cash flows. In capital budgeting techniques, all these cash flows are considered: initial investments, operating cash flows, and terminal cash flows. Now we will move on investment decisions criteria. We have different techniques that we can use to evaluate different projects. These techniques are net present value, internal rate of return, payback period, discounted payback period, accounting rate of return, and profitability index. Now I will discuss these techniques one by one with some examples. The net present value is the basic technique that is used in the capital budgeting techniques. The net present value is the present value of all incremental cash flows discounted at present minus the initial outlay. This is the basic formula that is used in calculating the net present value. Net present value is equal to present value of the cash flows minus initial investment. This is the same formula that we have studied in the time value of money. If NPV is greater than 0, we will invest in that project and the project will add some values. If NPV is less than 0, we will not invest in these projects as this project will destroy the value. If we see advantages of net present value, it is easy to understand. Consider the time value of money, consider all project cash flows. And the disadvantages is the result is a monetary amount, not a return. The example of net present value: consider the 3M project which require an investment of $1 billion initially with a subsequent cash flows of $200, $300, $400 and $500 million. What is the net present value of 3M project if the required rate of return of this project is 5%? The best way to solve the questions related to time value of money is to draw the timeline where we will draw the cash inflows and outflows in each year. At 0 time period, we have cash outflow of $1,000. In first year, we have $200 cash inflow, $300, $400 and $500 respectively for the next years. All these values are in millions. When we will solve NPV, the NPV is equal to initially 1000 cash outflow plus the present value of all cash flows, 200 divided by 1.05 raised to power 1 plus 300 divided by 1.05 raised to power 2 and so on for the next values. The final answer of NPV is equal to 219.47 million. As the NPV is positive, so this project will add some values if selected. The second technique is internal rate of return. The internal rate of return is a discount rate at which the net present value of a project will be equal to 0. The formula of IRR is equal to cash flow divided by 1 plus R raised to power T minus outlay is equal to 0. It means the net present value of a project will be exactly equal to the initial investment of the project. If we see advantages of IRR, it is easy to understand. Consider time value of money and consider all cash flows, but it cannot be solved easily. If IRR is greater than the required rate of return, then the firm will invest in this project as this project will add values. And if IRR is less than required rate of return, firm will not invest in these projects as this will destroy the firm's value. Now we are going to solve the same 3M example for the IRR. We have initially $1,000 outflow, then we have $200, $300, $400 and $500 cash inflows for the next 4 years. This is the basic equation that is used. Initial outflow plus 200 discounted by IRR plus 300 discounted by using IRR, 400, 500, all these values are discounted by the IRR and this will be equal to 0. That solves this equation. The IRR is the rate of return that causes the NPV to be equal to 0. The problem is that we cannot solve direct IRR, but rather must either iterate, try different values of IRR until the NPV is 0, or use a financial calculator or spreadsheet program to solve for IRR. This is the formula that we can use to calculate the internal rate of return, IRR internal rate of return, IL interest rate or discount rate is somewhat lower than the firm's YTM, IH discount rate that is somewhat higher than the investment YTM, PVL present value at lower interest rate, PV actual that is the actual present value of the project, or in some cases the initial investment, and PVH is the present value at higher interest rate. We have calculated the present values by using different interest rates. If we use 12%, then the NPV is 20.20. If we use 13% discount rate, then the NPV will be minus 4.19. So we have used these values: 12% lower interest rate, 13% higher interest rate, and 1020.20 NPV at a lower interest rate, and 1000 present value of the project, and 995.81 is the present value at 13% discount rate. When we solve, we will get answer that is equal to 12.826%. The other technique is payback period. The payback period is the length of time it takes to recover the initial cash outlay of a project from future incremental cash flows. In the 3M project example, the payback occurs in the last 4 years. To calculate the payback period, we have again 4 years timeline and cash outflow and inflows during each years, and we will calculate accumulated cash flows. In the 0 time period, there is minus 1000, that is same. At first year, we have 200 cash inflows. In second year, we have 300 cash inflows. And to calculate accumulated cash flows, 200 plus 300 is equal to 500. In third year, we have 400 cash inflows that will be added in 500, resulting $900. In the last year, we have 500 cash inflows. When added in 900, the result will be 1400. The 1400 is a higher value than the 1000. So the payback period will be between third and fourth year. Payback period will be after 3 years but before 4th years. So the formula that will be used is equal to the payback period is equal to previous years, mean starting years, that is 3 plus initial investment minus accumulated cash flow last year divided by current cash flow. The current year 3 plus 1000 initial investment minus 900 divided by 500. The result is 3.2 years. The payback period is a very simple technique, but it has some drawbacks. Like, if we see these examples, we have multiple projects, project A, B, C, D, E, and F. We have calculated payback period and NPV of these projects by using the 10% discount rate. If we see first project, the NPV is negative and the payback period is 1, whereas in second project the NPV is 65 and the payback period is 4. If we use payback period, then the first project will be accepted from A or B, but if we follow NPV, then the second project should be accepted. If we compare the next project C, D, E, and F, the NPV of project is highest, but the payback period of project D and project F has same. Or if we compare all these projects, Project F has highest NPV, but the payback period of the first project A is minimum. Due to these conflicting results between NPV and payback period, the payback period is not most widely used. Secondly, the payback period does not consider the time value of money concept. And we know that cash flow received at the start of the year or cash flow received at the end of years have different values. So that's why the payback period is not a well-known technique to use in capital budgeting technique. The other is discounted payback period. The discounted payback period is the length of time it takes for the cumulative discounted cash flows to equal the initial outflows. In other words, it is the length of time for the project to reach NPV equal to 0. If a project does not pay back in terms of discounted cash flows, then its NPV is negative. It is easy to understand, consider the time value of money, but it ignores the cash flows beyond the payback period, and there is no criteria for making a decision whether a project is accepted or not. Again, we are going to compute the 3M example for the discounted payback period. Here we have years, cash flows. Here we have computed the present values of these cash flows by using a discounting method, and in loss column we have computed the accumulative present values. 190 as it is in the first year, 190 plus 272 results in 463, 463 plus 346 is equal to 808, and in the last year 808 plus 411 is equal to 1219. Again, when we use discounted payback period, it will be after 3 years but before 4 years. So again we have applied the same formula, previous year plus initial investment minus accumulated cash flows last year's divided by current cash flows is equal to 3 plus 192, that is equal to 1000 minus 808 divided by next year's present value, that is 411, is equal to 3.47 years. So we have computed that the discounted payback period is 3.47, but we cannot accept or reject this project based on the payback period. The other method that we can use is accounting rate of return. The accounting rate of return is the ratio of average net income from the project to the average book value of the assets in the project. It is easy to use, easy to calculate, easy to understand, but not based on the cash flows, and ignores the time value of money, and there is no investment criteria. The last technique that we can use in capital budgeting is profitability index. The profitability index is the ratio of present value of future cash flows to the initial outflow. Profitability index is equal to present value of cash flow divided by initial investment, or 1 plus NPV divided by initial investment. If the profitability index greater than 1, invest in the project as it will add values. If the answer of profitability index is less than 1, do not invest. Capital project will destroy the value. Again, we are using same example, 3M example, to compute the profitability index. The NPV, we have already calculated the NPV, that is 1219.47. So profitability index is equal to present value of the cash flow divided by initial investment. The answer is 1.29. So we will accept this project as it has profitability index greater than 1. So these are basic capital budgeting techniques that are being used. In next video, I will try to explain the issues with NPV and IRR, the modified internal rate of return, and some other issues related to capital budgeting techniques. If you have any questions or any confusions related to capital budgeting techniques, you can contact us. I will try my best to explain your answers in the next video or in the comment section of this video. Thank you. Take care. Allah Hafiz.